By watching this video to the end, you will understand why institutional traders are bracing for a surprise Fed rate hike, and how it impacts US dollar to Japanese yen and global markets. Odds for a hawkish surprise from the Fed have surged between 23% and 39%. With US dollar to Japanese yen touching 164 and crude oil plunging over 11%, global markets face an unprecedented inflection point. Market expectations heading into Federal Reserve meetings typically align with consensus. However, a sharp divergence has emerged between retail investors and institutional desks. While retail markets expect policy stability, institutional odds for a surprise rate hike have climbed to between 23% and 39%. This mounting tension is further compounded by extreme commodity volatility, as crude oil plunged over 11% in a single trading session. Furthermore, the US dollar index is surging near monthly highs, putting severe pressure on major currencies like the euro and Australian dollar. In Asia, US dollar to Japanese yen has reached the critical 164 level, sparking intense speculation over potential intervention by Japan's Ministry of Finance. Understanding this institutional setup is crucial as global liquidity shifts ahead of the Fed rate decision. The institutional desk at Citadel publicly called for a potential hawkish surprise from the Federal Reserve, driving institutional odds for a rate hike into the 23% to 39% range. Simultaneously, crude oil plummeted between 11% and 14%, reflecting a dramatic risk-off shift across commodity desks. In foreign exchange markets, US dollar to Japanese yen surged to 164, reaching levels where market participants actively anticipate intervention by Japan's Ministry of Finance. Analysts note that this move could signal the potential end of a 40-year uptrend if aggressive official buying occurs. Beyond major pairs, emerging market FX is feeling the stress. USD/IDR spiked sharply following a leadership shakeup at Indonesia's central bank amidst broader dollar strength. Concurrently, big tech earnings are kicking off with Meta, Microsoft, Apple, and Amazon reporting. Key benchmarks include Microsoft's Azure growth target of 39% to 40%, Amazon's AWS growth target of 33% to 34%, and Meta's option market implying a plus or minus $50 price move. On social media platform X, market sentiment reflects a clear divide between institutional positioning and retail traders. Pro traders are highlighting that Citadel's macro desk publicly called for a rate hike surprise, warning that institutional money is heavily braced for hawkish risk. Commentators on X emphasize that while retail investors remain complacent, institutional odds hitting 39% created a massive positioning gap. FX traders on X are closely tracking US dollar to Japanese yen at 164, noting that speculators appear reluctant to push the pair beyond 164 to 165 due to fear of an eye-popping intervention from the Ministry of Finance. Meanwhile, commodity traders on X are pointing to oil plunging 14% alongside DXY surging toward monthly highs, warning that Australian dollar to US dollar and euro to US dollar have hit pivotal support levels as broader risk-off sentiment takes hold. Institutional analysts and hedge fund macro desks are focused on the widening disconnect between economic data and Fed policy expectations. Citadel's macro call has forced institutional desks to hedge against a hawkish outcome, raising surprise hike probabilities as high as 39%. Professional traders note that an 11% to 14% drop in crude oil serves as a major disinflationary force, yet the Fed's reaction function remains the central question. Regarding Japanese policy, institutional currency desks observe that despite US dollar to Japanese yen reaching 164, the absence of immediate Bank of Japan action leaves the Ministry of Finance as the primary line of defense. Analysts stress that any intervention at these levels would need to be massive to alter speculator behavior, as global capital flows continue to favor high-yielding US dollar assets ahead of critical central bank decisions. For Japanese equities and corporate sectors, US dollar to Japanese yen trading at 164 creates a complex backdrop. While a weaker yen historically boosts exporters' earnings, extreme currency volatility and intervention fears create uncertainty. Furthermore, global market jitters ahead of the Fed decision are impacting overall risk appetite across Asian equity markets. Investor attention is also directed toward U.S. tech megacap earnings, including Meta, Microsoft, Apple, and Amazon, which heavily influence Nikkei technology components and global sentiment. With Microsoft targeting 39% to 40% Azure growth and Amazon aiming for 33% to 34% AWS growth, AI capital expenditure figures will directly signal demand for Japanese semiconductor equipment and technology supply chain partners. If a Fed hawkish surprise triggers a global risk-off sell-off, Japanese equities could face foreign capital outflows regardless of currency levels. Global macro spillovers are accelerating across foreign exchange and commodity markets. Crude oil's dramatic plunge of 11% to 14% signals intense risk-off repositioning, directly dampening commodity-linked currencies. The US dollar index is surging toward monthly highs, driving euro to US dollar and Australian dollar to US dollar to crucial support thresholds. In emerging Asia, currency contagion is already visible. USD/IDR spiked following central bank leadership changes in Indonesia, demonstrating how global dollar strength amplifies regional instability. In Japan, speculation over Ministry of Finance intervention at US dollar to Japanese yen 164 remains at a fever pitch. Traders caution that if the Fed delivers a hawkish surprise while Japanese authorities remain on the sidelines, currency pressure across Asia could intensify, threatening cross-border capital flows and triggering broader global market repricing. For individual investors, navigating this environment requires strict risk management and discipline. First, recognize that institutional odds of 23% to 39% for a Fed surprise hike mean volatility will spike around the policy announcement. Chasing US dollar to Japanese yen above 164 carries substantial downside risk if Japan's Ministry of Finance executes a sudden currency intervention. Second, monitor key catalysts including US tech earnings, specifically AI CapEx commentary and cloud growth metrics from Microsoft and Amazon. Third, avoid over-leveraging positions in energy or currency markets during high-impact macro events. Sudden 10% plus swings in crude oil demonstrate how quickly market momentum can reverse. Protecting capital, keeping adequate liquidity, and awaiting post-Fed policy clarity are critical strategies for retail investors during institutional repositioning. Looking ahead, three distinct macro scenarios could unfold following the Fed decision and tech earnings release. In our bullish scenario, the Fed maintains its current rate path while signaling disinflationary progress supported by the 11% to 14% drop in oil prices. Solid Azure growth of 39% to 40% from Microsoft and strong AWS figures from Amazon restore equity market confidence, easing US dollar to Japanese yen pressures as intervention risks abate and global risk sentiment rebounds sharply. In our bearish scenario, institutional desk warnings materialize into a hawkish Fed surprise or aggressively tight guidance. The US dollar surges, pushing US dollar to Japanese yen decisively past 164 and triggering a massive, eye-popping intervention from Japan's Ministry of Finance. Concurrently, high AI capital expenditure combined with disappointing tech guidance triggers global risk-off equity liquidations. In our base scenario, the Fed holds rates steady with neutral guidance, acknowledging lower oil prices. US dollar to Japanese yen consolidates near 164 under constant intervention watch, while megacap tech earnings meet expectations, resulting in range-bound market conditions. In summary, first, institutional odds for a Fed surprise hike have reached up to 39%. Second, US dollar to Japanese yen at 164 leaves markets on high alert for MOF intervention. Third, megacap tech earnings will dictate global market direction. If you found this breakdown valuable, please hit the like button, subscribe to Tokyo Macro, and share your thoughts in the comments below. See you in the next video.